Okay, so interest rate risk management is what we are going to be discussing. Now, what exactly do we mean by interest rate risk management? So always remember that basically what happens is that if you are a borrower, that is, if you are somebody who has to borrow the funds in a period of time, so you do face a risk that the interest rates may go up. You face a risk that the interest rates may actually go up. And similarly, if you are a depositor, whom we also call a lender. So being a lender, what do you do is that you face a risk that the interest rates are going to go down. So I repeat, if you are a borrower, you face a risk that the interest rates will go up. And if you are a depositor or a lender, you face a risk that the interest rates would go down. Now let's just discuss, let's just see that what is it that we do. So for example, right now is 1st of October. And I wish to have a transaction on the 30th of November. The rate right now is 10%. And what I'm expecting is, I'm expecting that I need to borrow the money, I need to take the loan on the 30th of November. So my risk could be that the interest rates would go up to 12%, the interest rates could go up to 13%. That could be one of the risks that I might actually face. So right now, it's 1st of October, the interest rates right now are 10%. I'm facing a risk that if I take a loan on the 30th of November, the interest rates might go up to 12%, might go up to 13%, something like that happens. So resultingly, if there is a risk that the interest rates might go up to 12%, 13%, so I will end up losing the money. Similarly, let's say the interest rates right now is 12%. I'm expecting that I will get some money. I repeat, I'm expecting that I will get some money. And I will be depositing this money for some period of time. And what I'm actually facing is, I'm facing a risk that the interest rates right now are 10%. And when I will actually have the money to deposit, the interest rates might go down to 8%, might go down to 7%, things like that might actually happen. So always remember, you could face a risk from the perspective of a borrower. You could face a risk from the perspective of the lender also. So if you want to borrow the money, you can face risk. If you want to deposit the money, you can also face risk. Now, in order to hedge against this interest rate movement, there are different type of instruments that are used. And amongst the different type of instruments that are used, that includes forward rate agreement that we call FRA. The second one of them is interest rate futures. Interest rate options. Interest rate swaps. And the fifth one of them is the collar hedge. So what I'll do is that I'll try to make sure that I cover the maximum techniques so that you people have an idea that how exactly are you going to deal with the situations related to these questions when they come to the examination. The first one of them is basically called the forward rate agreement. Now, when we talk about the forward rate agreement, what exactly do you mean by this forward rate agreement? Let me just explain to you. The forward rate agreement is an agreement to borrow, or it's an agreement to lend amount at a future date at an agreed rate. So I repeat, what exactly do you mean by the forward rate agreement? When we talk about the forward rate agreement, the concept of forward rate agreement is it's an agreement to borrow, or it's an agreement to lend the amount at a future date at an agreed rate for an agreed period. So what is it that you have to do? You have to borrow an amount at a future date at an agreed rate for an agreed period. How does it happen? Let's say you're a company right now. It's the 1st of October and you need to borrow $1 million for 1 year. You are entering into $1 million for 1 year on 1st January 23. So this is 1st October 2022. And you want to borrow into 3 months time on the 1st of January 2023. Now what actually happens is that, let's just talk about it. Basically, what you do is that you go to different banks, and finally, what is happening is you are entering into a negotiation with HSBC Bank. But what HSBC is saying is that we are going to lend this money to you at a Libor rate, that we are going to lend this money to you at Libor. Now, you are facing a risk that the Libor would keep on fluctuating. So you insist to the HSBC that instead of giving us this loan at a variable rate, why don't you give us at a fixed rate? Why don't you enter into a contract with us for a fixed rate loan? So HSBC says that, look, this is not possible. All that we could do is that we could give you the money at a variable rate. We cannot give you the money at a fixed rate. So if you want, you can get the money at variable rate, but fixed rate is not there. Okay. You try with the other banks. Okay, what's Libor? Okay, Libor is London Interbank offered rate. So generally speaking, depending upon which financial market are you actually obtaining the money from, or which specific financial market you are actually transacting in, there is going to be a rate prevalent for that market, and that rate would usually be based on the financial capital of that country. Like London is the financial capital of UK. In New York, you might actually have got the NIBOR, which is the New York Interbank offered rate. So it's the exchange, it's the interest rates at which all the banks trade with each other. Or you could have this Shanghai Interbank offered rate, SIBOR, etc., etc. So Libor is London Interbank offered rate. It's the rate that is prevalent in UK. If the banks are borrowing between each other, this is the rate that's usually prevalent. So the HSBC bank says that we are going to be lending the money to you at Libor. So if, let's say, on the borrowing date, if the Libor is 10%, you would pay us 10%. If the Libor is 12%, you'll pay us 12%. If the Libor is 8%, you'll pay us 8%, so on and so forth. Now let's move a bit forward and let's talk a bit further. So basically what would happen is that the London Interbank offered rate. Now I'll move a bit forward and I'll talk a bit further about it. So you go to other banks also, but none of the bank is actually agreeing to make payment to you. Now Barclays, what they do is that they say that we cannot lend you the money. We cannot lend you the money. We don't think that we will be able to lend you the money, but we can do one thing for you. Now, what is that one thing that Barclays is willing to do for us? They're saying that what we can do for you is that we can offer you an FRA. what we can do is that we can offer you an FRA. What's the FRA? It's the forward rate agreement that we can do. We can offer you. Now, now when we talk about the Barclays offering you an FRA, the Barclays says that, look, whatever happens, whatever the interest rate that is prevalent, we are giving you a guarantee for 12% rate. You can actually trade with us at 12%. You can agree to your rate of 12% with us. We are giving you a guarantee that your interest rates is going to be 12%. So that's what the Barclays actually tells us, that your interest rate is going to be 12%. Now, what does it mean? This means the Barclays is telling you that, look, if your actual borrowing is 14%, so what you do is that you pay 14% to HSBC, and we at Barclays are going to pay you 2%. So resultingly, you would stand at 12%. Your net position is going to be 12%. Similarly, if you borrow the money at 11%, so pay 11% to HSBC, and you pay 1% to us, the Barclays. So resultingly, 12% is going to be your net total cost. So when we talk about the forward rate agreement, what actually happens with respect to forward rate agreement is that what actually happens is that you would say that the forward rate agreement actually fixes your interest rate. What does it do? It actually fixes your interest rate. How does it fixes your interest rate? It fixes your interest rate as if you are going to be paying, or you're going to be receiving an X amount of interest irrespective of whatever happens. Is everyone okay till now? Okay, let's move a bit forward and let's discuss further. Now, when we go about having the FRA, so usually what you do is that you go to the banks for the FRA. Now, in the example that I gave you, what was the role of Barclays? Barclays was actually a bank that was just trying to take advantage of a possible advantageous position. Barclays was just trying to take advantage of their position, that they were thinking that the interest rates would be in their favor and they would actually end up earning 1% or 0.5% or 20% or 2% or 3% extra from you. That's what Barclays was trying to do. So usually what happens is that the banks, these are the banks who actually offer you these FRAs. So what you do is that you go to the bank's counter, and the banks would actually be offering you FRAs like this. They might be saying 3-6, 4% to 5%, or they might actually be saying 3v6, 4.2% to 4.8%, or 3v9, let's say 4.3% to 5.3%, things like that. Now, what exactly do you mean by all this? So just try to understand the FRAs. This is the time period for the FRA that is mentioned. And what is this? This is the interest rates that are actually going to be mentioned. Now this rate, which is the lower rate, is the rate applicable to lender. And this is the rate which is applicable to borrower. So the lower rate is the rate which is applicable to lender, And the higher rate is the rate which is applicable to borrower. Now let's move a bit forward. When we talk about this 3-9, 3V9, 3V6, so on and so forth. So what happens is that this means now, this means 3 months, this means 9 months. So basically, what does this 3V9 or a 3-9 FRA means? That you would borrow in 3 months for 6 months. You would borrow in 3 months for 6 months. Or you would lend in 3 months for 6 months. No, they won't be. They won't be. They won't be. It's actually just like that. One of the bank is willing to lend. The other bank is willing to take advantage of the possible bargain position. So depending upon who you are, if you are a borrower or depending upon if you are a lender, the FRAs would actually prevail. I'll give you one example and I will then ask you people to actually try to attempt that example, and let's just see that to what extent you are able to attempt this scenario. So let's say an entity wishes to borrow $5 million for a period of 7 months in 3 months from now. Available FRAs are as under. 3-7, 3-13, 3-7-10, 3-10. Okay, the required is calculate the net cost if the actual borrowing was made at example number 1, example number 2, 11%, 7.5%. So I would like you people to actually try and do this example. I would like you people to do this example and establish that what is going to be the net amount. So I'm giving you 5 minutes and then I'm going to resume. So we are just going to try and do this example. It says an entity wishes to borrow $5 million for a period of 7 months in 3 months time. Available FRAs are as under. So basically it's going to be it's going to be 3-10. That's the relevant FRA because 3 months from now and for a period of 7 months. So 3-10 is a relevant FRA, and since you are a borrower, your rate is going to be 8.6%. Case number 1. Actual borrowing is 11%. The interest cost is gonna be 11% into $5 million into 7 upon 12. So hence resultingly, what happens is $5 million into 11% into 7 divided by 12. So this actually gives you 320,833. That's your interest cost. Now what actually happens is that, as I said, that this is your interest cost. Now what next is there? The next situation is settlement under FRA. What's the settlement under FRA? 8.6%. So the agreed rate is 8.6%. So 11% minus 8.6% multiply 5 multiply 7 upon 12. We have actually paid extra. So we are going to receive this amount. Hence, resultingly, what would happen is you will end up getting 250,833 as the net cost. Similarly, if your actual borrowing is at 7.5%, so what's going to happen is that actual interest that you would pay is 7.5%. So it's actually going to be 5 million multiplied by 7.5% multiplied by 7 divided by 12. Gives you 218,750. Then there is this settlement under FRA, which is 8.6% minus 7.5% multiplied by 5 million multiplied by 7 upon 12. Which is actually going to be 32,083. 32,083. Resultingly, what happens is you'll have 250,833. That's the cost. So no matter what happens, no matter at what rate you are going to borrow, you would ultimately be standing at this cost of 250,833, 250,833. Okay, why is the interest cost negative? You're paying the amount, right? You're paying this amount to the bank. This is the amount that you're receiving. You're paying this amount to, let's say, HSBC, and you're paying this amount to Barclays. You're paying this amount to HSBC and you are receiving this amount from Barclays. So if I try to actually calculate the effective interest rate, so the effective interest rate is going to be 250,833 divided by 5 million multiplied by, since we need to annualize the rate, so we're going to reverse it. It was for 7 months, so we're going to reverse it. So it's going to be 8.6%. So that's what we are going to achieve. So basically, no matter what happens, whenever we talk about the forward rate agreement, just always try to remember this thing, that you have actually fixed your interest rate. And no matter what happens, ultimately your interest cost would remain the same. I repeat, no matter what happens, ultimately your interest cost would remain the same. Your interest cost would remain the same. Okay. Let me just guide you. let's say you are actually borrowing the money from HSBC and you have agreed under the FRA with Barclays. So what is actually happening is that this interest cost that you are paying is to HSBC because you have borrowed the money from HSBC. And this settlement under FRA is being received from Barclays because Barclays is settling the fund to you. The reason being you borrowed at an extra rate. You borrowed at 11% and you've agreed to an FRA of 8.6%. Similarly, this is HSBC. This is Barclays. You get my point? Yeah, Aditya, did you get my point? Okay. Now you see what happens is that in one place, Barclays is paying us. In one place, we are paying to Barclays. You see, think about Barclays. Barclays was just sitting there. We went to Barclays for the loan. Barclays says, no, we cannot give you a loan. We said that we have an issue with the HSBC. The HSBC is giving us a variable rate loan. And the interest rates could fluctuate. Barclays says, okay, you borrow the variable rate loan from them. And what we could do is that we could give you an FRA. Now, what is Barclays trying to do? Barclays is trying to take advantage of the position. Barclays is obviously speculating that the interest rates would be low. Barclays' speculation was this. The interest rates would be 7.5%. So you would be paying 7.5% to HSBC and you have agreed to 8.6% FRA. So you'd be paying the balancing amount of 1.1% to Barclays. That's what the position that Barclays was forecasting. That's why they entered into an FRA with you. So it's a derivative transaction. It's a transaction for short-term gain. You get my point? Okay, how about the rest of you? Are you people okay with this? Okay, lovely. I'm going to create an example for you from the perspective of a borrower. I'm going to create an example for you people from the perspective of a borrower. And I'll see that to what extent you people can do it. Okay, here you go. This is an example. I would like you people to take 5 minutes and try to do this example. Okay, let's just try to see this. Now, it says an entity wishes to deposit $11 million for a period of 3 months in 7 months from now. So starting from now, 7 months from now, you will deposit the money for 3 months. The available FRAs are as under. So what are the available FRAs? 3-7, so and so, so and so. So what do we need? We need 7 plus 3 equals to 10. So we need 7-10 FRA. And since we are a depositor, so the lower rate is going to be us. So it says calculate the net cost. Well, I should have written the net income if the actual deposit was made at this rate. One of the deposit rate is 9%. One of the deposit rate is 7.5%. So the interest income is gonna be 11 million multiplied by 3 upon 12 multiplied by 9% and 7.5%. Because in one place it's gonna be 9%, in one place it's gonna be 7.5%. So it's actually gonna be 247,500. And it's gonna be 206,250 here. What's actually gonna happen is you would say settlement under FRA. So you see, you have to receive an income of 8.2%. Here you receive an extra income. You would have a payment of then there is going to be a second case where you would actually have a receipt of so let's just try to see this. It's gonna be $22,000 is what you have to pay back because you've earned an extra income. And 19,250 is what you're gonna receive. So hence resultingly, what's gonna happen? You would say 247,500 minus 22,000, 225,500. And this is also going to be 225,500. So basically, when we talk about this interest income, this is how it is going to be 225,500. What is it going to be? 225,500. Okay, you see, what happens is that Aditya, that's what you need to realize. Because what happens is that you have entered into an FRA. Entering into the FRA would actually mean what? Entering into the FRA would actually means that you have agreed that you will actually be sticking to this rate. It's a fixed rate. It's a rate that has been agreed. It's a rate that has been decided. It can't change. You see, it's a rate that has been agreed. It's a rate that has been decided. It just cannot change. So you have to stick to your rate 8.2%. You earn 9%, you got to return 0.8%. You earn 7.5%, you'll receive 0.7 extra. That's how things are gonna operate. Do you get it now? Okay, good enough. So what have we done? We have actually discussed about the forward rate agreement. Now, what I could actually see from whatever that we have discussed in today's session is that a lot of you people, you're taking a bit of a time to actually get to understand this movement of the interest rate. Now, what I am actually going to do is that I'm going to conduct, I had originally planned that I would go about doing this whole interest rate risk management in one single session, but I don't think that it's worthwhile doing it in this whole one session. I would rather keep extra sessions, and I would rather do one bits and pieces. You can do the effective rate, Faithar. Now, I would actually do bits and pieces. Like I would take 3 more classes to do this, to do these remaining parts of the interest rate risk management, because I think going on with a 3-hour session for one single interest rate risk management would be a bit of a daunting task for you people to actually absorb it. So what I'm going to do is that I'm not going to continue further today. I'll just keep it till here, and I will have more sessions in which I'll do separately the swaps. I will do the interest rate options, interest rate futures, and the collars and all that. Now, in the meantime, if any one of you have got any questions, any queries from the session of today, you can ask. And in case if there is any feedback that you would like to share, I'll be happy to have those feedbacks. And the next classes you will be updated about it.